What's up, everybody? Not too much engineering in this video today. We're going to be looking at bank runs in ancient Rome. This is inspired by the news today. Jamie Dimon, CEO of JP Chase, released his annual shareholders meeting, and in this meeting, he detailed the fact that he believes the banking crisis is no longer over, and the crisis that we're referring to is the contagion that could have been spread from Silicon Valley Bank.
A rough week for the banking industry.
The collapse of Silicon Valley Bank.
The second biggest bank collapse in U.S. history.
The Silicon Valley Bank collapsed on March 10 after a run on deposits doomed the tech-focused lenders' plans to raise fresh capital.
In ancient Rome, there were three different financial institutions: private, the public, and money lenders. Argentari, Mensari, and the coactors. Again, I probably just butchered those, so I apologize. These institutions accepted deposits, they made loans and other financial transactions. However, this is where the parallel can't be drawn, right? So the depositors in antiquity had no guarantee. There was no FDIC insurance, right, on any deposit they made. So with there being no insurance, there's also no guarantee that you can go tomorrow to the bank and request your deposits back. Bankers across the Republic developed their own set of standards to be able to practice. These standards were developed independently from Big Brother or the government. Today we would consider them regional banks, operating under a set of rules that they all kind of agree on. Some historians believe that societal values were the glue that kept the Roman banking system held together. Specifically, the Roman virtue pietas. And that can be described as respect for the natural order. Politically, religiously, socially, etc. So the way it was described to me as it would not be pietous to scam or cheat a banker. Now the Argentari, or the public bankers, they weren't used by the elites in antiquity. The elite Roman class made a habit of lending their money to each other for large-scale production and operations. So think Crassus and Caesar. So we went through all that to lay the groundwork and explain why bank runs in our modern sense weren't really a thing in antiquity. The setup was completely different. The expectations were different. But I was able to find a recording of a bank run by Titus Livius, a historian from antiquity. He wrote about in his monumental book, Ab Urbe Condita. I know I butchered that, but anyways, it essentially means from the founding of our city. In book 8, chapter 28, he detailed a scene in 326, the year 326 BCE, right? So BC, before Common Era, about a group of soldiers. They'd been serving in the Roman army in Etruria. They returned to Rome and demanded their pay from the Argentarius that held their fund, the bankers that held their funds. Argentarius, or banker, had invested the funds, was unable to immediately provide the soldiers with their money, which led to a panic between the soldiers and a run on other banks as well. Livy describes the chaos that ensued. People rushed to withdraw their money from the Argentari, the banks. With all this cash now out of the system in people's hands, the price of goods ends up skyrocketing. In response to this, the Roman Senate passed a decree requiring all bankers to provide security for the money they held on deposit in order to prevent a similar thing from happening in the future. Now, this does have to be taken with a grain of salt. I've saw some reports that the story he's writing about obviously is decades later, so he's relying on evidence that he wasn't there for. But either way, it is very cool to see what we would consider a bank run. There were many instances of people trying to withdraw their money en masse from the Argentari, but because of the differences in the economic system, it's hard to point to more specific bank run examples as we understand them today.